The yield curve is a graphical representation that shows the relationship between the interest rates or yields of bonds with different maturities, typically government bonds like U.S. Treasuries. It plots the yield on the vertical axis and the maturity of the bonds on the horizontal axis, offering valuable insights into investor expectations about interest rates, economic growth, and inflation. The shape of the yield curve is a key economic indicator. A normal yield curve, which is upward sloping, shows that long-term bonds have higher yields than short-term bonds. This is the most common shape and indicates that the economy is expected to grow, with possible inflation ahead. Investors demand higher yields for locking in their money for a longer period because of the increased risks of inflation and uncertainty in the long term. This signals a healthy economy with normal growth expectations and rising interest rates. An inverted yield curve, which is downward sloping, shows that short-term bonds have higher yields than long-term bonds. This unusual situation suggests that investors expect economic growth to slow or even contract and possibly anticipate lower interest rates in the future. Investors demand higher returns for short-term bonds because they expect long-term rates to fall. Historically, an inverted yield curve is considered a recession indicator. It shows that investors are seeking safety in long-term bonds, pushing their yields down as they anticipate future economic trouble. A flat yield curve shows that yields on short-term and long-term bonds are very close to each other. This suggests uncertainty in the economy. It may indicate a transition period, either before the economy moves into a slowdown or recession, or before a period of growth. A flat curve can signal that the economy is at a turning point, with investors unsure whether growth will accelerate or decelerate. A steep yield curve, it's when long-term yields are significantly higher than short-term yields. This shape indicates strong expectations for future economic growth and possibly higher inflation. Investors, well, they expect the central bank to raise interest rates in response to inflationary pressures over time. A steep yield curve typically suggests an economy is in recovery or expansion with robust growth expectations. Factors influencing the yield curve include interest rate expectations, inflation expectations, economic growth, and risk appetite. Interest rate expectations. The shape of the yield curve often reflects investor expectations about future central bank policy, like the Federal Reserve in the US. If investors expect interest rates to rise, the yield curve will steepen. If they expect rates to fall, the yield curve may flatten or invert. Inflation expectations. Inflation erodes the real returns on bonds, so investors demand higher yields for long-term bonds if they expect inflation to rise. This pushes the yield curve upward. Economic growth. A normal or steep yield curve suggests expectations of strong economic growth as rising rates reflect a growing economy. An inverted yield curve indicates concern about an economic slowdown or recession. Risk appetite. When investors become more risk-averse, they tend to buy safer, long-term government bonds, driving their yields down. This demand can lead to a flattening or inverting yield curve, especially if economic uncertainty is rising. The importance of the yield curve can't be overstated. Bond market indicator. The yield curve helps bond investors understand the potential risks and rewards of investing in bonds of various maturities. Economic indicator. Economists and analysts use the yield curve to gauge investor sentiment about future economic conditions, particularly with respect to growth, inflation, and recessions. Recession predictor. The yield curve has been a historically reliable predictor of recessions, particularly when it inverts. An inverted yield curve has preceded every U.S. recession in the past several decades, though the timing between inversion and recession can vary. How it works in practice is fairly straightforward. If the yield curve steepens, meaning long-term yields rise faster than short-term yields, it may indicate that investors expect stronger future growth or higher inflation. If the yield curve flattens or inverts, it suggests that investors expect slowing economic growth or a potential recession, as they anticipate lower interest rates in the future. In summary, the yield curve is a powerful tool that reflects market expectations for interest rates, inflation, and economic growth, making it essential for both bond and equity investors when assessing economic conditions.